The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we have a very special episode for you. Last week in London, we put on a live event. We were supported by leading reputation management consultancy Lansons, whose clients include Lloyds, Allianz, BlackRock, Fidelity, JP Morgan, Soc Gen, Vanguard, and many, many more. The topic of discussion was Crypto 2.0. Is crypto finally getting real? Considered fringe for much of the past few years, crypto and associated technologies potentially represent a meaningful force in mainstream financial services as they mature. Joining us to explore the near future in crypto and the implications for banking, finance, and society as a whole are Lex Sokolin, Luis Carranza, and Alexi Esmail-Yakas. Each guest introduces himself at the beginning of the discussion, so I won't duplicate it here. If you enjoyed today's episode and are interested in future live events in London, the US, and around the world, please subscribe to our newsletter at bankingthefuture.com. Thank you very much for joining us today, and a huge thanks to Lansons for hosting this event. Please welcome Lex, Luis, and Alexi. In terms of tonight's conversation and framing it, if we're in this room, I imagine we're interested to some degree in crypto and everything that's been happening in the space over the past handful of years. We were all there in 2017 as things got frothy, and 2018 as they rapidly cooled off. And the premise of the conversation and the reason why it felt relevant to bring it together is that over the past, call it 2 years, massive amounts of real money has flowed into the broader crypto space. Tokens have lost value, Bitcoin has lost value, Ethereum has lost value over the past, 12, 15 months now. But that doesn't change the fact that well-funded, smart, technically sophisticated entrepreneurs are working in the space and building to solve real problems. So I'll let the panelists start by introducing themselves and giving a bit of background, and we can pick it up from there. Lex, do you want to start?
Thanks so much, Will, and thank you for joining us this evening. My background is a little bit of a hodgepodge between the luckiest investment bank of them all, Lehman Brothers, which was my introduction to what is a permanently skeptical view of financial services. Then as a founder's CEO and various sort of other operating roles, building out a robo-advisor in the States. So that's sort of like a neobank in the UK, except Americans don't care about banking. We only care about investments because when we reach 65, there are no social services and we starve and die. So you need robo-advisors. Most recently, I've been the global director of fintech strategy at Autonomous Research. Autonomous is a firm that helps large money managers figure out how to invest in public financial services companies. And so in that role, I've looked at everything from artificial intelligence to insurtech to regtech to every other kind of tech that has a finance term in front of it, and was lucky enough to get interested and deep dive on crypto, blockchain, and the related themes during the time when it became super complicated and having a point of view was useful for people. So between those three experiences, I think this is one of the most impactful places to work and invest and build. And this is a place where actually an individual can make a difference relative to a lot of the different other opportunities in finance. So super excited to be with you and happy to have the conversation.
Luis.
Great. Hi, I'm Luis Carranza. I'm founder of London FinTech Week and Blockchain Week. Collectively, the company's FinTech worldwide. We've run about 35-odd FinTech and blockchain conferences around the world since about 2014. So we've kind of traveled the world and talked to people, met interesting people. I also own a small equity stake in Applied Blockchain, which is a company that makes and builds blockchain products. I think Shell is now a major stakeholder in it, and they did the first energy derivatives trade, I think, sometime last year. So it's pretty cool to be a part of that and help them grow along the way. And then I met Lansons when we helped launch Innovate Finance, the industry body for fintech. So it was going to be called, I think, Our New Economy. I helped change the name to Innovate Finance because the Chancellor's office wouldn't go for the Our New Economy, apparently. So you have me to thank for that name. Other than that, I enjoy, blockchain, digital strategy, and just keeping up with all the latest and exciting changes in technology and finance in particular.
Thank you. Alexi?
Hey, I'm Alexi Esmail-Yakas. I'm head of trading at Elwood Asset Management. We're an investment firm that's focused solely on digital assets. And so as far as my background is concerned, I used to work at a hedge fund called Brevin Howard, where I worked as a trader for the founder. So I've been trading fixed income, equities, currencies, and also the founder's cryptocurrency, which is how we started at Elwood, where he formalized his investments in cryptocurrency into a separate business. So we do proprietary trading, and we also focus on creating investment products for institutional clients. So that's kind of what my focus is on, is less on the technology side, but more on how cryptocurrencies as kind of an asset class are developing. And what I find really exciting about the space is, and why I moved full-time into the space, was because we're building a new asset class from the ground up, and we're seeing about what needs to be done, what needs to happen for institutional investors, and more inflows of money to come into the space.
And you guys were recently featured in Bloomberg for a product that you launched. Can you talk a bit about that?
Yeah, sure. So we launched an ETF that focuses on investing in publicly listed companies that derive their revenue from blockchain-related activities. So this can be from anything like the CME, which has a product that their Bitcoin product, to IBM that has solutions for private blockchains, and then also more interestingly on potential plays in the space. So companies like Rio Tinto, who have assets in hydroelectric energy, which can be repurposed to crypto mining to increase their yields and profits. So this is an area that we're really interested in.
All right. So maybe to set the stage, Lex can kick us off. Just a kind of general intro to where we are and how we got here.
Sure. I'm going to do something that will be probably difficult for the podcast listener, but I'm going to try to translate it. Okay, so show of hands, how many people in the audience at one point or another owned a Bitcoin?
An entire Bitcoin?
If there was one Bitcoin for every millionaire, then or something, I think is the argument. Okay, so sorry, I was being snarky, so I didn't look at who was doing anything. All right, so like 70-ish, 60-ish% in the audience. How many people have bought something other than Bitcoin? So let's say Ethereum or some other, okay, so 30-ish%. And then how many people have participated in an ICO off of a website? You like put in your personal information into the black hole and... okay, 3-ish. Okay, well, 5%. And how many people own a crypto cat? Oh my goodness, more people own a crypto cat than an ICO, which is, by the way, probably the right decision, but who knows? In 10 years, it'll be like the Van Gogh of crypto. Some people are laughing more than others, which reveals a personal failing, I think. Okay. An audience member has asked what a crypto cat is. So based on kind of the folks here, I'm going to walk through this a little bit. which is why this matters at all. So, you ask some people about blockchain, and the thing they'll talk about is distributed ledger, fungibility, transfer of value, international jurisdiction, all the stuff about the technical aspects of what digital assets are and why they matter and why they're the future, and that's all great. But for me, there's no sort of intuition why that's important, especially when you're in the developed world. You don't really, you're not really having fundamental problems paying for sandwiches or even doing remittance. So here's the very easy version for me of why it makes sense. So think about an economic good in the physical world. So take this bottle of water. It is instantiated in the physical world. It's real. It's an instance of a water bottle. And there's only one of it. And if I wanted to give it to you in the audience, you would have it and I would not. And potentially you could pay me for it and we would have economic activity around it, right? Sort of as human animals, that makes sense to us. So then comes 2000. Or even earlier, and we're starting to digitize objects. We're starting to digitize media, right? So what used to be a CD, which is kind of like this water bottle for which we would have economic activity, is now an MP3. And if I wanted to give that to anyone in the audience, I would just take a copy and send it to everybody. Marginal cost is 0, and the value of the music is 0, and therefore everything on the internet is free, from media to music to movies to whatever you want. Therefore, the only product that works is advertising. Therefore, you are the one for sale. Therefore, Facebook, Cambridge Analytica, and Trump, right? So if you want to share, if you're on peer-to-peer Napster, ... peace in North Korea. Did I get? Okay, good. All right, we got it. There is sparse laughter in the audience. So what does blockchain and Bitcoin and the rest of the crypto assets do fundamentally? For me, it's the fact that let's take this digital water bottle, let's say, which is rendered in virtual reality or augmented reality, or let's take that music file and let us program it in a way that assigns it to an address on a blockchain. So all of a sudden, in this virtual reality, or let's say this is a Bitcoin, I can take this object and give it to you, and then I will no longer have it. And you will, and you potentially can pay me for it. So this restores economic activity into the web around digital objects. And that is sort of, for me, the fundamental step in terms of what it opens up, right? So whereas you did not have a model for real digital commerce other than some sort of subscription or advertising or monetization through merchandise, blockchain restores that. So people can actually trade digital objects. They're instantiated, or you can digitize physical things like land, put them on a registry, move them around, assign them to people. So this is a long answer to what a crypto cat is. A crypto cat is a picture of a cat rendered as a cartoon that is unique and real in the sense that it has an identity on the blockchain, and that identity can be transferred and controlled by an individual with encryption, blocking the ability of anybody else to own it. So it was the first kind of real consumer example of somebody owning a digital thing. Not in this like, oh, I have some MP3s on iTunes, or I watch stuff on Netflix and I can access it, but in a way where you totally and for real control a digital thing. There's only one of it, and it's in your pocket. And so that is a long and weird answer to your question. Well, I don't know if this provided any context. I think it kind of helped people maybe think about what's valuable.
I think it provided an excellent entry point into the broader conversation, which is around, as you've pointed out, fundamentally new types of technologies that are more suitable for a quote-unquote modern world, right? So time moves on, world changes, new technology developed to support that. The financial system, to pull Alexi in, has traditionally worked to design solutions to support real kind of consumer or business problems on the front end. So we're also seeing that infrastructure laid. And I think the part that we should pick up on and include in this kind of initial level setting is around the infrastructure that's required to support the seemingly simple CryptoKitty example, right? And perhaps Luis, you want to jump in here? You mentioned the investment in applied blockchain and your kind of finger on the pulse of the broader space. So, from an infrastructure perspective, where are we, and what should people be concerned with?
I think one of the trends that you'll be hearing from the panel is all about the securitization of assets. The cat being the original securitized asset. But because you have securitized assets coming into the market, one of the key findings I'm seeing is that companies that are used to creating wallets and holding places for digital assets are having to think, what would an institutional grade wallet for securities look like? And in doing so, a lot of the thinking around what a wallet should look like is leading to how do we standardize a security to move from jurisdiction A to jurisdiction B, wallet A to wallet B. So a lot of that stuff is being worked out at the moment because of the different rules and regulations and even some of the things that come with securities like voting and how those are exercised. So you're starting to see the rise in security wallets, which is quite interesting. Another thing that's materializing is the securitization of things like property. But another trend unrelated to this that I think is quite interesting is that the companies that survived are morphing into something else than what they started. So, for example, if you look at a company like EOS, who were probably raised a boatload more than anybody else in the market, they're starting to behave more like a financial services firm. They're hiring people from banks. They're more focused on their funds, and they're actively investing in growing their ecosystem. But because they sold while the crypto was high, they're actually just a big financial company that needs to make money off the money they have. So yes, they need to build their ecosystem, but they've morphed into something completely different. You're also seeing companies that had a mandate to do things like create communities around a particular topic or token, having to pivot into something that's a bit more tangible. So it's quite interesting to see all the mass pivots that are happening, because once the token stops rising, you still have to deliver on a promise. And if you have money, you deliver it slightly different than if you don't.
So I'm going to just jump in to create some contradiction. And I think this last piece of the outcome is completely psychotic, right? Which is, I'm EOS and I've raised $4 billion because I have a super nice website. Or if you take, another project, Tezos, and it's, they raised a little bit less, a couple of $100 million, again, on very much an idea. And the idea is a better or faster Ethereum, which is a better and faster decentralized or sort of world computer that runs across multiple nodes, right? So instead of executing a program on your phone or your desktop, you're doing it on a whole network. For the people in the audience who pirate music with BitTorrent, you'll feel at home.
Can we get a show of hands?
Yeah. Yeah. So it's a really exciting future-forward thing. And essentially what these guys did, not in particular EOS, but many of the companies that said we're going to go out and build this technology resource, they raised the money, and then instead of building the resource, they turned themselves into venture funds. So imagine, you have a leak in your sink, and you're trying to fix it, and so you're like, I need a plumber. I'm going to hire a plumber, and the plumber gets there, and they find a bunch of diamonds in your sink, and they say, oh great, now I'm going to be a venture capitalist investing in plumbers. And you're just like, why? You're not qualified either to be a plumber or to be a venture capitalist. And so I think it is just a super bizarre outcome.
I want to pull Alexi into this. So you mentioned that you were effectively covering from an investment standpoint the crypto space through 2016, 17, 18 from the sound of it.
Yeah. So early 2017, 2018. Yeah.
So presumably that suggests you were applying good old, traditional investment techniques like research and analysis to the decision making that you were making. And I'm sure that part of it was kind of quantitatively oriented, i.e., which direction is the price likely to go, even if we don't care why. And parts of it were more kind of intellectual. What purpose is this solving? What tangible value is likely to result from this? I mean, I'd be curious from that experience. I mean, what do you now kind of in looking back and looking forward think about where tangible value kind of sits in this landscape?
Yeah, so we can think about this in different ways. So at the moment, cryptocurrencies are probably their primary reason is for speculative investment. So in 2017, that's what everyone got excited about, that they were going to become super wealthy, they were going to become financially independent, and it was going to be brilliant. And I think what 2018 showed us was that that's probably not right. And what a lot of people kind of got excited about outside of Bitcoin was, I'm going to diversify my assets throughout all of these, because I believe in the space. Bitcoin might not be the thing that comes out of this like utopia of decentralized world that we've kind of alluded to. It could be Ethereum. That sounds like a great one. Could be this thing called EOS. And that could be it. But really, what people didn't understand was they understood this thing called diversification. But what 2018 showed was that you can't diversify your portfolio when everything is correlated. It doesn't make sense. So that's everyone in finance alludes that the only free lunch you can get is diversification. So you can't diversify when everything's moving the same way. So that's what kind of everyone found out in 2018, and it's kind of like first year university stuff, or even GCSE finance, if you could do a GCSE in finance. So really in 2018, in terms of speculative assets, you had to find different return streams in cryptocurrencies that were not correlated to each other. And so we've seen more recently things like lending markets developing, as well as just being long or short. You're also seeing things like derivatives developing, so people betting on like the volatility of cryptocurrency assets. So these are like investment products that have existed in traditional finance for ages. So people are now trying to apply these to cryptocurrencies. And so with all these different things now, you might be able to get different return streams and diversify properly. So that's what kind of like 2017 and 2018 kind of we learned from just regarding cryptocurrencies as only speculative assets. So when you think about in finance, why are cryptocurrencies or kind of digital assets important? I think Lex alluded to like how we had like a crypto cat as a digital asset, and you could transact that on the internet, and that was really important. But in finance, we've had there's been about just the act of buying like an equity or stock and share. So we've had about maybe 40 or 50 years of development of that trading activity. So a long time ago, if you wanted to buy a piece of equity in a company, you would pay someone for a piece of paper that gave you the rights to that share of the equity. And as financial markets developed, the exchange got really, really good. So we could buy equities at nanoseconds. So you have like algorithmic high-frequency trading that people buy and sell equities at super high speeds. But really what happens on the back end is that these things still have to settle within 2 days. It takes 2 days to hand over that ownership of equity from one person to another. And when you think about us transacting at these high speeds, it's kind of almost ridiculous that it still takes 2 days to settle this thing. Now, with the advent of blockchain and digital assets, it means that settlement can come down to zero. So we can transfer ownership of an actual asset, a legally binding asset, to somebody within nanoseconds again, depending on the scalability of our blockchain, which is why people find blockchain talk about scalability quite a lot.
So I'd like to bring Lex the skeptic in again at this point. So I heard two things there, but both of which are very compelling, but at the same time are potentially raise questions. One, that this is a better way of doing settlement. So is the system broken and does it need to be fixed? And two, a lot of traditional kind of financial mechanisms, from lending to clearing and settlement, are being kind of evaluated for potential application of this new technology, i.e., a solution looking for a problem. What are your thoughts?
Yeah, so I would love to knock down the sandcastle, but it's not a bad sandcastle as far as these things go. For sure, people will say that blockchain is a solution looking for a problem, and they'll look at 2018 and 2017 with sort of like this vindicated Warren Buffett type of approach. Of course, most famous is Jamie Dimon for saying JP Morgan will never do Bitcoin because Bitcoin is et cetera, while they have been working on JP Morgan coin the entire time. So as with a lot of financial incumbents, what you'll hear is no, and then you'll hear, oh, we invented that, when in fact actual entrepreneurs invented it 10 years before, whether in the case of Bitcoin or neobanks or robo-advisors or Venmo and payments, et cetera. So I wouldn't put very much stock in what the large banks say about why the thing doesn't work, because at the end of the day, they will re-engineer the thing so that it fits their models better. That said, there's a couple of comparisons. One is artificial intelligence. So artificial intelligence really got kicking around 2014 when the hardware started to be able to run massive kind of neural network mathematics on top of massive data sets of various animals, cats and dogs from the internet, or on, in the case of humans, their faces on Facebook and so on. Without that data, without that hardware, AI wouldn't have gotten off the ground. It just so happens that all the math was 50 years old. Right? So there's a 50-year lag in the case of artificial intelligence with multiple sort of peaks and winters where VCs got excited and sad and excited and sad about the theme until it could actually work. And you needed to have these triggers. When looking at crypto, it's in some ways similar in that the cryptography is not necessarily cutting edge or brand new. The combination of cryptography with payments and accounting is new, but that is 10 years old, and who knows if it's going to take 10 years or 20 years or 50 years. And certainly the advent of the blockchain phones will make a huge difference. So when everyone in the audience stops hearing the word blockchain or crypto and just has a smiley face on their phone that unlocks for them these decentralized apps is, I think, when we'll get over it. But for sure, if you look at the implementations of today's blockchains to traditional financial problems like equities and fixed income, generally speaking, they will generate worse outcomes. Generally speaking. So there's been large companies from IBM to consortia like Hyperledger trying to make that stuff happen, and it's been tough because the existing solutions are super fast and quite good. On the other hand, for private equities, for venture capital, for real estate, for paintings, for boats, for various rights in pharmaceutical drug trials, none of that stuff is really securitized down to a fraction of a dollar or available to retail investors. And so that's, I think, kind of a corollary of a massive opportunity where you are opening up new asset classes. You're giving people the chance to lose their money in all sorts of new ways. End of the day, choice is good, and good products will emerge, whether they are packaged as an ETF or whether we all have securities wallets that can hold all the stuff that Luis had mentioned. So I think regardless of how janky it can look today, it's actually really great progress.
Yeah. And Alexi, back to you. In terms of the institutional interest in the space. I imagine there's some funds who are happy to be able to buy your ETF because they, I don't know, don't have a mandate that allows them to invest in underlying assets or whatever it is, or they require a certain level of liquidity. And I imagine there are institutions that are looking at it on a more kind of granular deal-by-deal basis, looking to invest in building the infrastructure.
Yeah, I think that someone described it to me the other day. So if you consider like a pool of, which is like with varying deepness, and at the deep end is like buying Bitcoin and just holding until you realize like 100x. Nah. Till you make some money, or that.
There's Bitcoin and there's Bitcoin.
Well, and then at the other end, it's really shallow. But I would say that like our blockchain ETF is probably at the pool bar, like having a drink. So it's like really low touch at the moment. But this is what investors kind of want. They want the companies like IBM that have revenue streams attributed to blockchain, and they want to see the asset class developed. I mean, like a lot of people are kind of worried that blockchain might not be a thing, and it's like again a solution looking for a problem. But yeah, there's but then on the flip side, there's a lot of people that want to get involved in like the venture capital sides, building from the ground up. They see it, they're super excited about it. And then on the other side, you've got investors that are scared of like the macro outlook right now and are looking for uncorrelated assets. And cryptocurrency is currently an uncorrelated asset. Whether or not you believe that you want to see 80% drawdowns in your uncorrelated asset is another thing. So institutional investors getting excited about the space kind of lie within that sort of realm. And there's a lot of different things that you can do in that space, yeah.
So I'd like to ask Lex to maybe pull a few pieces together and kind of wrap up this initial part of the conversation, and then bring the audience in a little bit and get some questions. But so okay, Lex, so we've kind of covered some of the more interesting stuff that's happening right now, and what the implications are for the future. Can you describe for us what a potential end state to all of this might look like?
Absolutely. So I appreciate you guys bearing with my attempts at humor, and this will be just a little bit more specific about what I'm excited about and what I think people are building towards. If you were to draw out or map out the finance value chain, if you were to take Goldman Sachs and break it apart into little pieces, or Schwab and take it apart and break it out to all of its component parts, you start out with custody, so the ability to hold the thing. Then you move to exchanges, New York Stock Exchange and the others, the ability to trade the thing that is custodied. Then you move on to fund manufacturing, so making the stuff that has performance, has returns, which we've talked about here as an ETF. And then that's just product. There's 10 more steps to get to a human being. So usually that travels along to some sort of software that analyzes the performance return of the product. Then that goes into an asset allocation, that goes into a portfolio management system, which goes to a financial advisor, which gets the risk assessment of an individual human being and what they should be buying, which goes into a CRM, and then maybe on a website or a mobile app. So there's a whole kind of value chain that is not yet built. The only pieces we have today are, broadly speaking, custody and exchanges, and maybe a little bit of the manufacturing of asset management product. People don't buy asset management product. People are sold asset management product, and usually they're sold that product inside of pie charts. So where does it end if you actually do this whole value chain in a crypto-native way, meaning that you start from scratch on blockchain-based systems, as opposed to everybody has their own database, reconciles between each other, negotiates the errors, and then only trades in large chunks because it's so painful to do it otherwise. And the answer is pretty straightforward, which already we've seen massive progress in a decade. So if you think about the year 2002, and let's say you go to the fanciest private bank or wealth manager that you can find, what you're going to get is $1 million minimum to invest, and you'll get an asset allocation, and in it will be equities and fixed income and probably some commodities and maybe some real estate. And if you're real wealthy, you'll get some private equity and venture capital and hedge fund exposure, and maybe some weird stuff like pork bellies and timber and leftover uranium. So that's your global asset allocation. That's adjusted on a tactical basis by a super expensive academic that left for the private sector. And that's what that firm offers in 2002. In 2015, you can essentially get that on a mobile app at a $10,000 minimum. You're not going to get the private equity or the hedge funds or the uranium, but you'll get 10 asset classes diversified across different factors, fixed income, real estate, ETFs, all that stuff, and you'll get it for less than 0.5%. In 2025 or 2030, when all this stuff rides on the blockchain, on a blockchain-based system or generally a distributed ledger that's adopted, what you're going to have is that global asset allocation with 20 different asset classes, as esoteric as you want, with private equity or real estate or diamonds or anything else. You'll have those 20 asset classes, and then you might want to have automated rebalancing built into that portfolio. And so it will be the portfolio that has the rebalancing. It won't be done by a human to the portfolio. And on top of that, that portfolio will change as you age and as your circumstances change. So if you have a kid, it might get more conservative. As you buy a house, it might get more aggressive depending on how your life is. We can program that portfolio to siphon information out of Facebook or WhatsApp or wherever you like, or it will be programmed for you if you live in China. Regardless, that will be a smart portfolio holding these assets. And of course, the minimum account size will not exist. So you could do this for 25 cents for your newborn the moment that they're alive. And that is the destination. It's entirely impossible on the rails where we are today without counterparty risk, but it's entirely feasible if you do build on the Lego pieces that the folks to the right of me are actively working on. And I think it's super exciting and completely changes what a financial product and what a financial firm is.
And I guess the connection back to the opening comments around CryptoKitties is that not only are traditional financial assets tokenized, but digital assets and non-traditional financial assets are also tokenized.
Yeah, so these things are nested, so there's no conceptual difference between this portfolio and a CryptoCat, right? So a CryptoCat is a digital asset that might have a bunch of functions, like a CryptoCat can marry another CryptoCat and so on. They can have CryptoCat children. With a digital security that sits on a blockchain, voting is a function as part of the asset. Distribution of dividends is a function as part of the asset. In what I've described for a portfolio, which might have functions of rebalancing, trading and selling, adjusting itself based on what it knows about you. Again, that's sort of that's a smart contract that would be unique and travel. And you don't need anybody to give it to you. You don't need Merrill Lynch to package it for you and sell it to you for some fee. You just receive it from the network, and you own it. And you own it in your phone, which is probably at that point going to be chained into your skull. But we'll see how that goes.
All right, guys. Well, thank you so much for participating. Drinks at the back. Let's keep the conversation going. Big hand to Lex, Luis, and Alexi, please. Thanks for tuning into Rebank. If you like today's show, reach out.
Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.